Hi, everyone. Welcome back to the final part, the final section. I won't say the final countdown. We'll start singing it. We have two more talks for you. So we're going to start off with a talk from Richa and Julie from our finance team. And then we have the closing keynote after that from our CEO, Tom Blomfield, which will be followed by a short Q&A. So thank you. Welcome, Julie and Richa.
Hi, I'm Julie. This is Richa. Yeah. Hi. Yes. We're from the finance team, so we'll get started. Yeah. Cool. So what do we do as a finance team? We try to make money work for Monzo. And what does that mean exactly? So I'll let you read this tweet. So it's pretty accurate. We're the third and fifth people in the finance team that's joined. And it's actually, even though we've grown to 30 people, it's still not too far off what we do day to day today.
So as this implies as well, we do everything to do with forecasting, fundraising, tax strategy, all our numbers. We have data scientists in our team as well as engineers. We look at our internal banking ledgers, all our systems. Also, as a bank, as you can expect, we have a heavy load of regulatory reporting as well, and just making sure we're always on top of our daily capital and liquidity and everything that comes with that, basically, as well.
So what's consumed the last 6 months of our time, or specifically Richa's time?
So this is our annual report, which we launched on Thursday, which I'm not sure if you guys have seen yet, but there was a little bit of questions on our community forum when we would actually release this, and I just wanted to clarify kind of in terms of timings what we'd look to do. We usually release our report end of June, early July-ish, and this is because that's our deadline for what we submitted to our regulators. And because we are putting this information to our regulators, we actually, as an internal choice, we also just like to publish it online for full transparency at the same time, just as a good practice as we do with most things as well. So a little bit of a poll because it's only been about 2 days, I think, but how many pages do you think is our annual report? Does anyone want to have a guess? Obviously from a reader. Yeah, exactly. So our annual report was actually 92 pages this year, which is painfully in my memory now from having to read every single page so many times. So a little bit of how many pages is annual reports for other banks out there, which I did a little bit of just like 6 as a comparison to see. Now, this isn't a real fair comparison either because all of these banks are listed banks, which means that the regulation on them is a lot more, which means there's a lot more that they have to include in the annual report. But this is just to kind of show how much information is actually contained in these documents that you can get out of it. And it's also just to say that, I guess in our growth journey as well, this is kind of what we're probably going to head towards, but we're going to try and do it in a Monzo way. As we have more regulation, et cetera, we're going to have to try and balance the readability of what we put online, but also balance that with what regulators and regulations actually expect for us to put in the document, which is going to be a key challenge for us. So how do we actually do annual report at Monzo? So I thought I'd give a little bit behind-the-scenes look as to actually what goes into preparing this report and kind of what we did over the past 6 months. So this is kind of very easily broken down into 4 broad sections. First being like ideas and content for the report. Second being the writing, then fact-checking exercise, as I call it, and the final result of what actually went on our website. So just to start with ideas and content. So we started this process off in January this year, which was basically just to all get in a room, huddle together, and say, what do we actually want to say in our report this year, which is an interesting topic that led to a lot of debate because we're not a listed bank, which means the regulation on us in terms of what we put our annual report isn't as heavy. So it was a little bit of internal debate as to what we actually want to put out there, what we think our customers want to see, what our investors want to see. So we kind of, I guess the results of all that brainstorming was that we really wanted to improve the annual report from last year, which was quite bare bones and it was quite simple report, and actually give a lot more information to our customers that would give you a little bit more of a peek into how we operate as a bank, how everything works. So I guess I'll give you a quick summary of kind of the 7 sections that we decided to put in new this year. One of which was actually just a little bit of our history, timeline of who we are and what we are. This is especially important because we've grown so much in the year and we've got a lot more customers, a lot more users, that this is something that we thought people would actually be interested in, see how far we've come. A little bit on our team, like who makes up our board, who makes up our executive team. It's very important for people to know actually who they're trusting to run this bank. We obviously included a review from Tom, as we did last year as well, which was just a summary from him of where his mind is at as to how he thinks we did last year, where he thinks we're going as well. Newly, we included a review from Gary, our chairman, which I think was in for Q&A a bit earlier today as well, and he joined us new this year. And then one of the key bits that we wanted to put in was actually a summary of our business model and strategy, as well as a quick summary of our performance this year. What we found from last year's report was it was quite hard for our customers or our investors to actually get a sense of where we're at, what our kind of summary of our model is, what we want to do in the future, as well as just how we did in the year. It's quite hard to get that flavor from the back half of the report, which is a lot of numbers, a lot of tables. So that was something we wanted to put in and make it easy to read, as well as a little bit of a peek into our internal people, how we manage our internal culture, which is a lot more important now as well, because we've almost reached about 900 people inside the company. A little peek into how we manage our community, which is a big part of why everyone's here today, as well as one of the key things we wanted to do this year is also include a summary of how we approach governance, which I know Susan did a talk this morning about as well, and how we do our internal risk management, which is also key for us to be fully transparent about. So one of the key things actually that came out of the content that we wanted to put in was that we wanted to make the report as readable as possible and also try and include within it our Monzo tone of voice, which you may have seen on our blog, which is quite a big thing for us. We also apply it to other legal documents like our terms and conditions, which is quite hard to do for an annual report in a way. But we tried to do that as much as we could this year, and this is something we hope to do every year and make it as readable as we can for people. Actually, this is also a section where I'd love some feedback into if anyone thinks of anything that they'd like to see in the report, a little bit more detail on specific sections or just a whole different peek into Monzo. Please let us know in the community forum as well. It'd be great to hear from people. So now on to the writing bit of it. This was obviously a very busy process, specifically for all the numbers in the back half of the report, which is a long process, but I'm glad it's behind us in time for summer. And this is also something that we heavily involved our writing team in as well, just to make sure we were complying with a Monzo tone of voice as well in our writing. To give you an idea, we had lots of teams actually actively contributing to the writing of the report. You heard from Susan earlier from corporate governance, but we had the people team, we had our community team write a bit of it, our risk team, but a lot of other people. So it wasn't just a finance-focused report as well. So now on to the fact-checking part of the exercise, which, as I call it, is also refers to our external audit process. So as most you might know, is that obviously per regulation, we're required to have an external auditor. Our external auditor is actually Ernst & Young, and they come in, well, they came in about March time and were with us about 3 to 4 months of this year, just going through their audit procedures on all our financial statements, all our numbers, and they're also required to read the full report, including like the front half, just to make sure that it does give a true and fair view of our business. So this was a very big laborious exercise, as you can imagine, but it's truly important because that's how you get comfort as well, that the numbers we're quoting and the numbers we're putting out there as our results are as they should be. So I'm not sure actually if people have noticed, but now our external auditors also have a huge section in the middle of our annual report, which they sign off at as well, which is much longer than it used to be. It's about 10 to 12 pages now, I think. But if you want to have a read, kind of gives you a view of what they think of different areas that they looked at as well. So this was the fact-checking, external fact-checking. Then we obviously went through our internal process as well, which is getting in touch with all the executive members of our team, making sure they're comfortable. If there's anything else they want to put in, our board members as well were given an opportunity to comment, to review, just making sure everyone was comfortable with the overall message in the report. And then the final result, which was on the website on Thursday, which is a huge project that our design team actually helped us with to make sure it looks and feels like Monzo, and it looks great, and it's a bit easy to read, not too many words and pages, and numbers on one page, and all those things. And I think they did a great job of it. And we've also put a web version on as well now, after Thursday, so it's easier to look on your phone, etc. Cool. So we'll move on to how did Monzo do this past year, and a little bit of detail into that. So this was also in our annual report, but just to kind of bring a little highlights here today, we had about 1 million new customers in the financial year up till February 2019, and just for a little bit more context, as of today, we're about at 2.3 million customers.
Something we're super proud of is our NPS score, which basically tells us how happy our customers are with us. So we've gone from 70 to 80, and it's been holding steady around the 80 mark for the last few months. It's pretty amazing when you think about some banks have a negative NPS score.
Our customer deposits obviously have increased by about 400 million in the financial year, and again, as of today, it's sitting at about 600 million as well.
And lastly, we more than doubled our headcount, or the number of employees that we have internally, 300 to 713, and we're actually getting close to 1,000 now, which is pretty amazing. Yeah. Okay. Should I get the clicker? Yeah, I do this. Cool, thanks. So now that we've talked about all the good things, I wanted to go through the numbers a little bit more. You might have seen some of the headlines that came out. So last financial year, we lost £30 million, and we got loads of negative press on that. So this financial year, we were like super prepared for all the criticism that we would get. So stuff like this about the mounting losses. The articles actually haven't been that bad. So we do have mounting losses. We went from 30 to 47 million pounds loss in a year. But we just wanted to dig in a little bit deeper beyond that sort of headline number and give you some more context on what's really been happening. So this is just a quick graph to show you what our revenue trend has been like, which is a dark blue at the top, and then the expenses growth at the bottom. So if you did read the FT article, we talked a lot about wanting to be here for the long haul, which means that we want to make decisions today that make sure we're successful for many years into the future, and that we're not taking shortcuts to profitability. So we're making a lot of very conscious decisions to invest in our product and our people. And as other speakers have said, we're in a highly regulated environment. So that means that as a company, we have a lot of costs and just operational things that we have to take care of that other companies might not have to bear. And we don't intend to ever get into trouble with our regulators. So we're focusing on our governance and our control structures as much as we are on our products and our platform. But back to the numbers, you can see that while our net loss grew, we have been steadily growing our revenue. For the month of February 19, which is when the financial statements were based on, we were under £30 million of annualized revenue run rate. And now May, June, only a few months later, we've already blown past 40 million annualized revenue. So that is growing. Of course, the costs are growing faster than the revenue. So again, just to give you a bit more color on what's actually happening there, just a quick graph. So the main categories of things that we're spending on really is the personnel, our account servicing costs, customer onboarding and customer acquisition, and lastly, our operating costs. So our personnel, which is all our salaries, options, expenses, taxes, and benefits and things, that really is the majority of our costs. From there, we have the account servicing, so that's what we call variable, anything that we need to spend on to service our customers, so 24/7 customer support, card transaction costs, even our back-end like web servers. So these are all things that will grow directly in line with the number of customers we have. So we expect that to keep going as we get more customers on board. The third one, account onboarding and acquisition. So those are all the marketing costs that we spend to get new customers, and onboarding being what we need to do to get a customer signed up. So things like distributing your first card or the ID verification checks that we have to do. And then the smallest bit you can see are the operating costs, which people also call our fixed costs. So things like our rent, technology subscriptions, legal consulting. You can see that actually makes up a really small part of our cost base. Yeah. And of course, a Monzo Finance talk won't be complete without talking about contribution margin, or what we affectionately call our customer unit economics. For those who don't know, a contribution margin is the profit or loss that we make from each active customer that we have. And just to recap, I don't know how many people have been following us since the prepaid days. It's something we talk a lot about internally and in the media as well. But as a recap, we peaked at about a £65 per customer loss in September 2017, which is back when we were still on the prepaid program. By the time we got to February 2018, we were migrating customers onto the current account, and we actually were able to halve that to £30. Last October, November was a big milestone for the company. We actually broke even on a customer basis. So we've been going steady, positive contribution margin for the last few months. So in the financial reports, you can see that we hit £2, and we're now May, June, sort of £5-6 positive per customer. So all good news. Cool. How were we able to do this? So to be fair, we focused a lot on scaling costs for the last few months. Mm-hmm. So when we were on the prepaid, we had to use a few third-party suppliers, which we don't need to use anymore now that we're doing the in-house current accounts. We've also spent the last few months negotiating on a lot of contracts to get better pricing with our suppliers. As our volumes are growing, we have more market power to do this. And on the flip side, what we've also seen is the revenue growing. So we're seeing the early days of lending revenue generation come through to help push this up a little bit as well, which is quite exciting. Yeah. So a bit of a poll, since you're all investors. We wanted to find out why you invested. Put your hands up if you did just simply because you love the product. I was hoping for more hands, but okay, good enough, yeah.
So put your hands up if you invested because our amazing team made it just so easy and simple for you to do so, that you did so without even realizing that you did. Yeah. Honesty.
Yeah. Good, I think. Put your hands up if you did it simply because you just want a financial return on your investment. More hands than the product. Okay, guess that's why you're at this talk. Keep your hands up if you think you'll get your financial return in the next 10 years. 5 years? Next 2 years? Amazing. I don't know if that's a sign of faith in us or just if you're in with us on our long-term strategy. So I guess from here we wanted to break into what is Monzo doing next. And so there's been a lot of talk, a lot of companies like Uber and Lyft and Slack. So this question's been popping up quite a lot lately, for better or worse, which is, when is it going to be IPO time? And I just wanted to clear up, no, that is not happening quite yet. So I think Tom's talking after this. You can hassle him with more questions, but no. So where are we actually going? So we've talked a little bit about our long-term strategy, wanting to be here for the long haul and not taking those profitability shortcuts. What does that actually translate into today? We've had a lot of internal discussions about what we want to focus on and the things that we want to start making real headway in over the rest of this year. So some of the 4, main pillars that we're thinking about. One is customer growth. So we've earmarked about £25 to £30 million on marketing and customer acquisition this year. So our organic growth has always been strong. We've typically acquired about 60,000 new customers a month with basically no efforts. With the spunky new TV ads that hopefully you've all seen, we've actually blown through 200,000 new customers for the last couple of months each. And it's been at quite, overall, with all our advertising and different efforts that we're doing, our customer acquisition cost has been quite low, about £10 per customer. And that's pretty amazing when you think about some banks spend up to £150 to acquire each new customer that they have. Why are we doing this? Mostly just a little bit of economy of scale, but also as we decide to roll out new products, obviously we want a meaningful customer base to engage with our new products. which brings us onto the second bit. So creating products. We've been working on our lending business for quite a while. We've had overdrafts out for the last year or so. We're also ramping up loans quite a lot. Unfortunately, because of the way some of the accounting treatment rules work, it means that as you grow your lending book, we'll probably take a bit of a hit on our financial P&L over the next year, but that's something that we can grow out of as our lending book really grows and scales, so we're not too worried about that. The other things that we're working on, you might have heard about earlier today, Monzo Plus, Monzo Points, so we're really excited about getting those out. And also just optimizing our marketplace. So we've got our energy and savings partners out there, so we're hoping to build that out a little bit more throughout the rest of the year. The third thing is business banking. So we weren't successful in getting one of the RBS grants earlier this year, but this is something that we feel we can make true headway in the market and offer something a little bit nicer than some of our competitors. There is a little bit of complexity around business banking, more so than retail banking. So like we do with all our products, we'll get something out. We're going to trial it with a few thousand customers over the next couple of months, and we'll just keep learning and iterating and hopefully get something out in the medium-ish term, no timelines, that hopefully fills in the gaps that we're seeing in the market today. And the last bit, which you've probably seen a lot of headlines about, is our international expansion. So we officially announced earlier this month that we're going to be doing our first foray overseas, which is with a US prepaid top-up card. Again, I'm not doing a full big bang because there's a lot we need to learn. There's a lot of differences between the UK-US market in terms of competition, regulatory things, and what customers want. So we need to learn our product fit there. And again, because it is our first international product expansion, I think Monzo needs to learn a lot about how to operate as a global company and not just a domestic company. So we want to make sure, again, that we learn, we iterate, and that we do things right as we grow globally. So all in all, these are some pretty heavy initiatives that we are working on. They require a lot of upfront investment, both financial and staffing. And so obviously our hope is that the products will take off towards the end of the year. We'll start generating revenue from there. But all in all, we do plan to invest a lot of costs into these so that we can be successful for the long term, which means we are facing probably a much bigger financial loss over the next year than even today. And I just wanted to assure you these are all sort of like deliberate, conscious strategic decisions that we've made. Our aim is to move fast and in control. I don't know if some speakers have been quoting that quite a bit today, but that is how we want to operate. And we are ultimately focused on the long-term success, not just short-term profitability. So hopefully you all agree in that ride with us, and that's part of why you invested. But yeah, that's pretty much it. Cool. Yeah, thank you.
Thank you, Julie and Richa. And when you get a chance, can you pay my small tedious invoice? No, I'm just kidding. I'm just kidding. Now, you've heard from some incredible, varied areas of the business today, and I hope that you've learned a few things that maybe you didn't already know about areas that you might know less about. I know I have. I didn't know half of this stuff before I came in today, but I think one thing that we can all agree on is that we are a challenger bank is what they call us, and that's almost like a weird way of describing something, because how can you challenge an industry that's so old and regulated, and how can you operate as a modern tech company when you have to have meetings with these people that may not even understand the terms you're using or the structures that you're built on? And the answer to that is that you have to have the right leader, the person who understands all of these things and can explain them clearly and rationally and can communicate that vision. And ever since I started at this company, my belief has never faltered that we have the right person who can do all of those things and more. I've never been more impressed with the boss of some place that I've worked. It's really incredible. So with that said, it is my absolute honor to introduce our keynote speech from a name I'm sure you're all familiar with, our CEO, Tom Blomfield.
Thank you. Thanks, Simon. Hello, everyone. I'm not sure I can live up to an introduction like that, but thank you very much. First of all, I want to say thank you for spending, for some of you, 5 or 6 hours of your Saturday on the sunniest day of the year. I've got 30 minutes now. I'm going to talk for probably 15 minutes and just reflect on the last 12 or 18 months. I'd love to take questions if we have time for 10 or 15 minutes at the end, but I promise I will get you all out of here before 5 o'clock so you can go and enjoy your barbecue or your pub or wherever you're going next. So thank you so much for spending the day with us, and thank you for all of your support over the last few years. Really, the 37,000 or so crowd investors we have is absolutely phenomenal. We just have a small number here, over in our office down the road, and spread around the country and watching on the live stream. So thank you, thank you, thank you. We couldn't have done it without you. So the story starts almost 25 years ago, back in a small village called Little Chalfont. Has anyone been to Little Chalfont? Very good. I grew up in Little Chalfont. Someone at the back. I grew up in Little Chalfont, and I remember very vividly opening my first bank account at Chesham Building Society. Chesham was a town about 2 over. Go through Amersham, and then Chesham is the next one. And Chesham Building Society had a branch in Little Chalfont. And I went and opened my first bank account there at the age of about 10 or 11. And I remember very vividly, because I got a passbook, this sort of paper book about that big. They give you, you open the account, you give them some money, and they give you a passbook with a line written in, the money you've deposited, a credit to your account, they called it. And they summed up, only one credit, easy sum to do, to your total balance at the bottom of the page. And over the years, I sort of took in pocket money or checks from my granny at Christmas and wrote more credits to my account. And again, they summed it up and wrote the balance. And this was what I thought of as a bank account, this list of credits. And then when I had enough, I went and took my money out and buy a Man United football kit or something. They wrote a debit to my account, and again, summed it up to the balance. So credits and debits, long list, summed to a balance. And it's never really that up to date. You have to wait a few days to take your money in, and they sort of update it for you. But it's a bank account, right? You keep your money safe. And over the last 25 years, thinking about the innovation in retail banking, I moved from that passbook to NatWest. And instead of a sort of handwritten thing, I got a printed statement in an envelope. Big innovation. And then the next we had telephone banking. So you could phone up and listen to your list of your credits and debits, summed to a balance. Fine. And then we had internet banking, where you could log on and see on a screen your list of credits and debits, an amount summed to a balance. And normally 2 or 3 days out of date, didn't update in real time, but it was there, your bank account, digitized. And then the era of the smartphone. I remember extremely vividly my first ever smartphone in 2008. I had the iPhone 1 or 2, whatever it was at the time, my first ever job. I was so proud of this thing. And eventually, my bank came out with an app. And so I could log on to my bank and see in my banking app a list of credits and debits, which summed to a balance. About 2 or 3 days out of date, because it obviously wasn't real time, didn't do very much. But on this supercomputer, this amazing piece of technology, my bank used that basically as a cheaper way to deliver that same passbook experience I had at Chesham Building Society 20 years earlier. It's even the same size as a passbook, and it does about the same amount, my banking app. It lets me see a list of credits and debits that are basically out of date all the time. So banks have used technology as a way of providing basically the same products and services at lower cost, and sometimes even adding more fees and charges for the pleasure of it. Whereas, in the same time, we've companies like Spotify or WhatsApp or Citymapper, these things that are using the full range of the geolocation, the thumbprint, the video sensors, all of this technology to provide us with products or services that in their own small way makes our lives easier, simpler, quicker, more convenient, cheaper. They seem to be built around the human being, the customer. The customer is at the center of their universe, and they do everything they can to serve that customer. It's as if the customer is the center of gravity for these companies, that everything else orbits around and exists to serve the customer. And do incredible amounts of work to make it just work, to make it seamless and easy and transparent. But again, you go back to the banks, and although every one of them says we are customer-centric, the center of gravity at the bank really is the financial product, the mortgage, the credit card, the term loan, whatever it is. Everything revolves around the mortgage, basically. And the customer is one of those things, which is why it feels like you sort of have to contort yourself when you're interacting with some of these services, because it's not built for you, it's built for the mortgage. And you're a sort of moderate inconvenience, frankly. So they can sell you the mortgage, get you out of the way, and then focus on their mortgage book. And so we started Monzo now 4.5 years ago with the aim to start with the customer, to put the customer at the center of gravity of Monzo, and to do everything we could to make the products and services we offered just so delightfully great that it feels like it's an extension of yourself, like all of those other apps I mentioned, WhatsApp and Citymapper and Spotify. So it feels immediate and real-time and transparent and fair and convenient, without any of the annoying fees and charges that piss everyone off. And I think we've done a pretty good job so far, and we couldn't have done it without your help. So I want to run through a sort of greatest hits list of the last 12 or 18 months, things we've accomplished, which some of which even now seem quite incredible. So just a year ago, 12 months ago, the company was valued at about £240 million, give or take. It's now valued at £2 billion, almost 10 times more. In the last 12 months, we've added £200 million of funding, over £200 million, including around about £20 million of crowdfunding, which I'm incredibly proud of, 36 or 37,000 crowd investors. We've refreshed our board. We've brought, some of you may have seen Gary Hoffman, who's our new chair, who's been an absolutely brilliant addition to our board. He came from Barclays and Barclaycard. He went into Rescue Northern Rock and then spent a stint of time at Hastings Insurance. He's been phenomenal in combining that depth of banking experience with a sort of pragmatism and a can-do attitude, and he's been a great mentor to me. So we've really, really developed the board over the last year or so. The next step for our board, frankly, is gender diversity. We've taken a step backwards on that, and the next 2 or 3 additions we make, I'm fighting very, very hard to make sure we have a diverse gender representation. Our exec team, we've made 4 C-level hires in the last 12 months. So Alwyn has joined as our CFO from Barclays. He's been a phenomenal addition. You met 2 of his team just now. Phenomenal addition, both stepping up the kind of financial control, but then adding a kind of level of strategic thinking that's been absolutely great. Tim Traylor's joined as Chief Credit Officer from Klarna, and he took a little while to bed in, but he's now really started to ramp up that lending book. So you should see lending volumes today are about £35 million. You should see that ramp to 150, 200 million pounds of lending over the next few months. So the team, I think, is really starting to motor there. Chief People Officer, Libby, has come from OVO Energy. She's been phenomenal. I wish she'd joined 2 years ago, honestly. Building out the hiring team and then all of the nuts and bolts that go into running a 1,000-person organization. She's been an absolutely great addition. And then Mary Williams as our Chief Technology Officer. She's come from Moo. I think she's just a beacon in the London, indeed the European tech community. She's been absolutely great for us. So thank you to all 4 of them. It's really changed the sort of dynamic, and the executive team is starting to, for the first time ever, to feel like an actual team rather than a collection of individuals, which I'm really, really proud about. So as we've crossed 1,000 staff a year ago, I don't know, we're 300 or so staff, based in an office here in London, 1 in Cardiff, 1 in Vegas, and we're about to open an office in Los Angeles, which I've never visited yet. I look forward to. We've had to think really, really hard about the ways that we work together, we set goals, and we communicate. When you're 30 or 40 people, it's really easy. You achieve this kind of mind meld I was talking about a few minutes earlier. Everyone's on the same page and sort of pointing in the same direction because you know everyone's names, basically. You cross what's called Dunbar's number, about 150 people, the number of people you can sustain sort of normal human kind of emotional relationships with. So as you get to 1,000 people, you're way, way, way beyond that. So what we've tried to do is split the company down into what we call collectives. So 10 collectives, each apart from COPS, each of which is about 60 or 70. COPS is now about 400 people, so again, we're subdividing that. And each of my C-level executives sort of runs 1, in some cases 2 of these collectives. And what we've tried to achieve there, first of all, is going down lower than Dunbar's number, frankly, so you can kind of maintain relationships with everyone in your collective. Secondly, it's to have all of the skills and capabilities you need in that group to achieve whatever the goal is. One collective is lending, another is growth in core product. But it's not just to have silos of engineers and designers and then sort of finance people and business people separate, but to have within the collective all of the different skills and capabilities you need to take an idea from conception through build and to launch and kind of maturity. So it's entirely cross-functional, each of these collectives. I think it's worked pretty well. And the other thing I wanted to achieve is kind of enabling each executive of their collective to be the spokesperson, to be the sort of the leader that says, we're going over there. Previously, that was me. And it was fine, but there's only one of me. And it's really confusing if I say 10 different things. People are sort of like, what is a priority? But as we've grown, it's impossible to have a single narrative. And for a period of time, for 12 or 18 months, it was fix unit economics, which I'll talk about in a second. We sort of accomplished that, and then people ask, what next? And what next is it's tricky, actually. We need to keep growing our customer base. So we're at 2.3 million customers, and we'll add 260,000 new customers this month alone, based off the TV ads. But at the same time, we need to get COPS, customer service, working really, really well, delightful, tell your friends service, but at a cost that's sustainable for long term. That's our second message. Then we need to grow our lending book from about 10 million a year ago to 35 million today and 150 million plus going forwards. We've got to grow that safely. But then we also want to build this kind of marketplace, this idea that all of your financial services are available in one place. We need to do it in a way that makes revenue. So again, Jonas takes a revenue incubator and says, we're going to develop new streams of revenue that's going to make Monzo sustainable. And then that's before you, I'm not going to go through them all, but you get the point that as we've grown, we become more complex and we need to subdivide and have leaders who can kind of set an ambitious goal and have 100 people sort of run at that goal. And hopefully the sum of all 10 collectives will be a really successful Monzo. So we'll come back in a few months and tell you how that's going, but the move to collectives so far has been really, really positive. So, unit economics, that's our big challenge over the years. If you'd come to events like this on our City Road office, you'd have heard me talk. Back in the depths of our prepaid scheme, we were losing about £65 per customer per year. The way that's calculated, briefly, you take all of the revenue generated by everyone or each customer, and then subtract the marginal costs, the cost that's created by the existence of that extra customer. So that's things like posting out the card, providing customer service, fraud, bad debt, the AWS cost, which we're able to apportion per person. So all of the revenue minus the marginal cost. 2 years ago, with the prepaid scheme, that kind of formula resulted in negative 65. Revenue was basically zilch, and cost was basically 65. Therefore, each customer burnt £65 per year, which got very expensive as we burst through 500,000 customers on our prepaid scheme. We're burning 30 million plus a year just maintaining the marginal cost base of the prepaid scheme. That's before you talk about office costs or finance or engineering or design. That's all the marginal contribution was very, very negative. A year ago, we managed to improve that to about, depending on whether in the year you pick, about negative 30. So it went from negative 65 to negative 30. Today, we're about plus 5. So that trajectory is going really, really well. But primarily, it's come through cost saving. So turning off Stripe top-ups and adding a fee for foreign ATM usage. Basically, both Stripe removed the cost, the fee for ATMs kind of offset the cost that existed from foreign ATMs. We've made customer service way more effective, and our AWS bill is about £2.50 per customer per year. So all of our technology spend per customer per year is £2.50. If you ask the CTO of any large bank what their per user technology cost is, it will be embarrassing. It'll be in the hundreds, if not thousands of pounds per customer. So just sort of think about that. And that's before you add the branch costs and all the staff costs. We're able to grow at 260,000 customers a month, which is 3 or 4 times faster than any other bank. Our cost per acquisition is around £10 or £11 per customer blended. That's about 90% lower than any high street bank. We're able to service an account for about £30, and we have £35 of revenue, with a technology cost of £2 or £3, which again is 98% lower than the big banks. So we're growing faster. We're able to acquire customers more cheaply. We service an account more cheaply. And what I'm proudest of all about is when we're rated #1 in the UK for customer service. A net promoter score of plus 80, and we knocked First Direct off their post as the first rated customer service in both Which and Money Saving Expert. So I think that combination of fast growth, incredible cost base, and maintaining world-class customer service is something we're hugely, hugely proud of. So the progress has been phenomenal there. Having said that, we are still loss-making. We released our annual report on Thursday, I believe, and last year we lost an amount. This year we'll lose more than that, honestly, because we're growing so quickly and hiring ahead. And this is a conversation we have a lot with our board and with our investors. Shouldn't we just slow down? Shouldn't we? We could hire fewer people. We could have not spent 20-odd million on growth this year. I think that would be a lower risk way of running the business for sure, but I think it would also reduce the expected value of the company in the long term, if that makes sense. So you have this trade-off. You can absolutely be more prudent. You can hire fewer people. You can not expand so quickly until you're making more revenue per customer. But the downside of that is someone else comes in and takes millions and millions of customers and figures out how to monetize them at scale, and you're left with a nicely profitable 50,000 customer bank, while someone else has the 10 million customer bank that is monetizing at scale. And so we've chosen to take more investment, to run a little bit faster, with the knowledge that we've made this great progress in the economics from -65 to -30 to now +5. Over the next year, that should go to +35, and then at scale, plus £150 per customer per year. So we believe these customers are looking really, really good. We can see all of the leading indicators, and it makes sense today to go out and spend 20 million on advertising this year to grow past 2 million customers to 3, 4, and we should be at 10 million customers in the next 2 or 3 years, which will make us one of the top 5 banks by customer numbers in the UK. Bearing in mind, 5 years ago we didn't exist. That's some achievement. But that is our strategy. It is a riskier strategy than if we grow more slowly, and I think we're very open about that. And it's something we talk a lot with our investors and our board about, and we're 100% aligned on that strategy. But as our investors here, I want to share that with you as well and give you the chance to ask questions. So I'll wrap up with a couple more thoughts. Unit economics has improved because of cost reduction. The next step is revenue. We need to significantly grow revenue per customer. We're making about £35 of revenue per customer. 60% of that is interchange, the amount you spend, the amount we earn when you spend on your debit card. We've improved revenue per customer by only about 20% in the last year, actually. So we've grown top-line revenue massively, but because we've grown the customer base massively as well. So revenue per customer has only increased by 20% in the last 12 months. We need to go from £35 of revenue per customer up to £60 or £70 per customer to get to that positive £35 unit economics we're aiming at. We're aiming to keep costs pretty steady. So revenue growth is vital. That comes from 2 things, lending and Monzo Plus, basically. Monzo Plus will encapsulate a range of things, but basically a monthly subscription service for additional bolt-on services. So that's going to be our real focus. Looking ahead, so that's kind of what the majority of the company is working on lending or Monzo Plus for the next 6 months. Thinking a little bit ahead, once we've solved that, other things have a long lead time. And so we're taking the first steps into business banking very soon and the US launch. We're not doing that because the US is the most important for us today. It's because it will become the most important thing for us in a year or 2, but there are very, very, very long lead times for a lot of this. It's why we're starting today, putting a relatively small team on it, so that once we've got really positive unit economics in the UK and have grown to 10 million customers, and then someone says, what next? We've got the US, which is ready to really start running. So that's a sort of investment in the future with a long lead time. That's why we're doing business banking in the US today. Finally, how can you help? So beyond investing and trusting us with your money, which again, we're very, very thankful for, I'd really love it if you could put your salary in, if you've not done so already. And as an added bonus, very soon you'll be able to unlock that salary a day early. We basically looked at the back 3-day cycle. We're able to release your salary at 4 p.m. the day before all of your colleagues if you put your salary with Monzo. So I think it's a really, really great incentive. We'll see how that goes. I'm very excited about it. But please put your salary with Monzo. It's important because it basically means you spend more on the Monzo card. You get a great exchange rate abroad, and you get visibility of your money in the UK. So there's no downside for you, but we earn way more interchange, being really frank. So for a customer who is salaried, our contribution margin today is about £30 per customer per year already. If you're not salaried, it's around neutral, break even. So please, please, please put your salary in. It won't cost you any more, but it'll be a huge benefit to Monzo. And you get paid a day early. The second thing you can do, and I'm sure all of you have done this already, please, please, please tell your friends. Invite your friends. Use the refresh golden tickets. They get £5, you get £5. And keep the kind of word-of-mouth buzz of Monzo going. Incredibly important. So please put your salary in. Please tell your friends about it. That would be amazing. So I will wrap up. We've got 10 or 12 minutes left there. I think there are roving mics. I just want to say before questions, thank you, thank you, thank you again. We really, really couldn't have done it without you. It's humbling to have 37,000 crowd investors, so thank you. My lovely assistants have the roaming mics. Put your hands up.
Thank you, Tom. Can we all please limit to one question each so that everybody has a fair shot? And Kim will be going around with the mics. Thank you.
Thank you. Tom, thank you. You've done roughly 1 or 2 fundraisers, mainly private money per year, and you've also just about once per year allowed us as private investors to get involved as well. And I think you've been clear in saying you think that makes Monzo stronger, and that is the reason you do it.
Yep.
Do you think you're going to be able to raise private money indefinitely for growth, to fund growth?
That's a great question. I think it is one of the biggest risks we face. While we are loss-making, we are reliant on external capital. As of today, we have approximately £190 million of surplus capital above our regulatory minimums, so we're pretty well capitalized today. It means we won't have to raise money straight away, certainly. But the biggest risk is there's some kind of global financial shock and private capital markets sort of dry up. And there are counterpoints. A lot of this sits in VC funds, which the funds are there committed already. And so I don't think it's going to disappear. So that's something we think about a lot, we monitor. We have kind of key risk indicators that we track, things like stock market prices and whatever. And if that's starting to occur, there are actions we can take. So for example, just not spending on growth, not spending on Give 5, Get 5, not doing Facebook ads, and cutting sort of future TV. So responses we can take in response to that. That's a tautology. There are responses we can take. We also can hire less people, right, and just accept that we'll do less in future. But for now, it seems like the private capital markets are pretty buoyant, and it's why we chose to take investment from Y Combinator without really needing to yet, just kind of build up that buffer. So I think we are very well capitalized, but we're also really keeping an eye on it to make sure it doesn't become a big problem. Where's the next mic? Let's have one here, and then we'll do a question at the back.
Talking about revenue, you mentioned that lending is focused, and also you mentioned that interchange fees bring money. So an obvious question, what about credit cards?
What about credit cards? What about credit cards? So credit cards are something that lots of our customers have asked for, and we know lots of our customers use. So of our 2.3 million customers, they've got unsecured borrowing of about 7.5 billion. A big chunk of that is on credit cards for a variety of reasons, whether it's points or cash flow. So it is something we are exploring. We're not announcing a launch. We will explore whether credit cards make sense as part of the core Monzo experience. And so maybe over the next 6 or 9 months, you maybe see a Monzo credit card. But honestly, we'll test it with very, very small numbers of users and internally before figuring out whether it really makes sense to do. So it's not going to be a launch in 2019, but possibly in 2020, it's on the cards. Right at the back.
Yeah, I was just wondering, do you have a number in your head in terms of how much cash you're willing to burn in the US before you might want to cut your losses, let's say?
I'd flip the question round, which is, what do we want to see in the US before we really put our foot on the kind of accelerator there? So right now we're burning very, very little on the US. We're not building a big team. We're not doing tons of advertising. We're going to start in the same way as the UK, which is in-person events, a few hundred people, until we see 2 things. One is positive contribution margin, that unit economics I talked about earlier. The US is structurally much more attractive because interchange there is about 6 times higher. So if we had US-style interchange in the UK today, we'd be making like 200 or 300 million pounds a year just off interchange. We'd be wildly profitable. And so structurally, it is more attractive. We want to make sure that the card, that we've got all of our sums actually are reflected in reality, and that each account is contribution margin positive. That's step number one. Step number two is making sure that we feel that pull of product market fit. We don't just want to take the product in the UK and assume it's going to work in the US. We need to tailor it for the payment systems and the culture, tone of voice, and make sure customers really want it. So we got to almost 2 million customers, from 1.5 million customers here in the UK without spending anything on advertising. We want that same pull of customer demand, because if you're having to build a customer base through paid advertising in the very early days without organic traffic, it's very, very expensive. So as long as contribution margin is positive and as long as we're feeling that organic pull of product market fit, then I think we'll start to invest, but we'll do so without having to burn too much capital because of the structurally more attractive interchange. This gentleman's been waiting a little while.
Hi, Tom. If the strategy works, when do you hope to get to positive jaws?
To
positive jaws. Income exceeds
profitability.
Spend.
Yeah. So bottom line profitability. I think where we want to get to basically is being capital self-sufficient. So that basically, I don't think there's a world in which we pay dividends in the next 10 years, frankly. I think we would use that money better growing Monzo further. And so I think basically your profitability basically hits the bottom line of your P&L, and then basically you add to your reserves and add up sort of your capital buffer in the UK. So that's the goal, that we become capital self-sufficient in the UK. But additional kind of profitability, we will continue to reinvest in growth worldwide. So I'm not trying to evade the question. It's not that we're avoiding profitability per se. It's rather that I think we'll create more value by reinvesting those profits, either in building a kind of capital surplus or by reinvesting in growth to build the company internationally. So the approach Amazon took, I think you ultimately deliver much more value for shareholders that way over a kind of 10-year period than getting to profitability and then issuing loads and loads of dividends. So in the UK, I could see us being capital self-sufficient in the next 3 or 4 years maybe, but again, it just depends on the velocity of growth. As long as private capital markets are buoyant and we can take more investment, and as long as our product is market leading, we're able to acquire customers much more cheaply than our competitors, it makes sense to continue to try and get more and more and more of them. It costs us something like £10 or £11 to acquire a customer, and the lifetime value of that customer at a big bank will be in the region of £10,000. That's just an insane investment. You're paying 10 to pay back 10,000. And so I think that is the trade-off we'll continue to make as long as we can keep raising capital. I just don't think it is going to be value maximizing to slow growth down and then return capital to shareholders. So that is the strategy. It has been played out before. It's one Amazon used in particular. Let's go to the back.
Hi. Are you focusing just on expansion to the US market or mainland Europe? Do you see mainland Europe as an easier step, maybe?
So 95% of the focus of the company is getting UK to sustainability, basically. 5% is laying the groundwork in the US for the expansion there. Approximately 0% is other markets. That is literally true. When we get to that, and that might be in 6 months or a year, I think we'd either look at European markets or basically Commonwealth markets, Canada or Australia. The reason we chose the US over European markets is that, and I think this speaks to a little bit of our strategy compared to N26 or Revolut, we've really tried very, very hard to tailor the product to the way people think and feel about their money. Things like direct debit notifications a day early, telling you if your direct debit has changed. Direct debit doesn't exist in other countries. I mean, you have a SEPA version in Europe, and then it's called bill pay in the US. But I think you have to really tightly tailor the product to meet the customer needs and expectations to have that kind of organic pull, that growth that we've had, and also to have the really deep engagement and trust that we have. You look at Revolut and N26, they have much higher kind of superficial customer numbers, but if you dig beneath the surface, most of those customers aren't active users. They're actually not using the account at all. the vast, vast majority of our customers are using the account. Of our 2.3 million customers, about 75% are monthly active, and about 58 or 59% are weekly active. Those metrics are staggeringly higher than our competitors because our product, I think, is tailored to the customer in the UK. And so when we go abroad, we want to make sure we have that same process of tailoring it. And the US has an advantage that it's 300 million people, more or less, who, again, more or less speak a single language, and they don't think uniformly about money in the same way, but there are similarities. And so we can do the work to tailor it for 300 million people. The issue with Europe is there are 28, soon to be 27 member states, and they speak a bunch of different languages, and they think about money in really different ways. It's not obvious unless you go and spend a bunch of time there. So in France, people are pretty used to paying a monthly fee for their current account. In Germany, very, very heavy cash usage because of huge fears about data privacy, basically. In the Nordics, people use bank transfer to make a ton of different payments that we'd never think about. In Italy, cash on delivery for an internet purchase is a thing that exists. Again, not in the UK, right? So you have to tailor for every single country. When N26 expanded into France, tiny thing, but their IBAN, basically the long account number for international transfers, said DE, not FR, Deutschland, not France. And the French customer said, this is a German bank. I want a French bank. And it's just little touches, I think, that go into creating this experience that feels natural and that you trust with your salary. So that's a very long answer for possibly not even the question you asked. We're picking the US because we think we can tailor the product and get a real kind of product market fit there. We are basically out of time now, so I would like to give two thanks, actually. The first is to all of the Monzo Nauts, the Monzo staff and friends who've given up not just their Saturday, but weeks and months going up to make this event a reality. So thank you very much to all of you. And finally, before you all go to enjoy your barbecues or your pub beer gardens, I just want to again say thank you. Some of you who invested back in 2016, I think, and then again in 17 and again in 18. Hopefully, it's an investment that will financially do really well for you. I genuinely believe it will, and I hope so, because of all the faith that you've shown in me and my team and in Monzo. It's absolutely humbling to imagine it's not just this room of 100, but 30-odd, 37,000 people around the country. It's just astonishing. So from the bottom of my heart, thank you for all of your support now, in the past, and in the future. Thank you.